Thanks for joining us. Appreciate you being here. I'm sure you're all thrilled and excited to talk about Social Security, so let's jump in. As Gail mentioned, this is my contact information. My name is Brad. I'm a financial advisor here in Albuquerque. Just to be clear, I do not work for Social Security. You can be skeptical, you can be critical, you can call it a Ponzi scheme. You're not going to hurt my feelings. And in addition to any of your questions, comments, feedback, here's what I plan to cover. Number one, will Social Security be there for me? A couple reasons I start with that question first. Number two, how much can I expect to receive? Number three, when should I claim? Number four, how do I maximize my benefits? So let me stop there. I was reading an article a few years ago. It said there's something like 700 different ways to claim Social Security. So good luck. And that's really the way the system is set up. It feels unfair, it feels punitive, but we've all been paying in for years, probably more like decades. And then when it's finally time to get the money back out, it can seem a little bit complicated and confusing. So we'll talk about some strategies to maximize Social Security. And then lastly, is Social Security enough to live on in retirement? Anybody want to tackle that question for me now? No. Probably not. I mean, unfortunately, there's a pretty large percentage of the population, and that's all they're going to have in retirement. And I say for those folks, this decision is really crucial. But for the rest of us, time permitting, towards the end of the presentation, I'll talk about some interesting ways to incorporate Social Security into the other moving parts and puzzle pieces of retirement. Talking about the value of Social Security, or is there even any value left to it? Again, some people call it a Ponzi scheme. I've heard it referred to as social insecurity. What are we pointing at?
I'd rather you look at that screen because I'm getting the back of your head when you look at the.
Nobody wants to see me anyway. All right. Is there even any value left to it? Right. So hopefully the screens are the same. Anyway, if I had to use one word for Social Security, I'd probably call it a pension. In theory, this is income that you will not outlive. It's going to pay you for the rest of your life. What's the best way to get back at the government, by the way? Live a long time, don't die. I know that's kind of counterintuitive to what we're talking about here today, but he who lives the longest gets the most checks, okay? If you look at the screen, just as a quick example, let's say somebody is retired, let's say they're collecting $2,000 a month. In roughly 10 years, they've taken about $276,000 out of Social Security in the form of monthly benefits. Now, don't get me wrong, that's a lot of money, but that's roughly a break-even point for most people that I speak with. You ever look at your pay stub, you're trying to figure out who's FICA, why are they taking so much of my money? So this is kind of a universal truth, right? So every time you earn income, you have to pay into this program called Social Security, 6.2% from you, and then it's 6.2% from your employer. So it's 12.4% of everything that you make is paid into Social Security. So I might encourage you to do some math. How many years have you worked? How much money do you make? You've probably paid in at least tens of thousands of dollars, if not hundreds of thousands. And that's before you get anything back out, okay? Social Security has a cost of living adjustment that's built into it. It's referred to as the COLA, cost of living adjustment, COLA. I'm using 2% on the screen. That's roughly what it's been over the last 10 years. Just as a, oh, by the way, this year's cost of living adjustment is actually 8.7%. Last year it was 5.9%. Those were the highest two consecutive cost of living adjustments that we've seen in the last 4 decades. Next year it's going to be closer to 3%. So the cost of living adjustment bounces around, as does inflation. So you can take that 2% with a grain of salt, but same math. If we started with that $2,000 monthly benefit, in 10 years, what was $2,000 is now closer to $2,400. In 20 years, it's closer to $3,000. In 30 years, it's closer to $3,600. So the good news is there is this automatic adjustment for inflation. Obviously, there's times when stuff goes up more than 2% from one year to the next. So a lot of times it's housing costs. A lot of times it's college education. And then almost always it's healthcare, Medicare, long-term care. So there's a whole other Medicare class that I teach. That's another fun-filled hour you can spend with me if you want. But take that 2% with a grain of salt. And as I mentioned, this will be the first major question that I answer. First major topic that we cover. Will Social Security be there for me? There's a couple reasons I start with this question first. Number one, there's not always 24 hours worth of news, but there are 24-hour news stations, and they're constantly vying for your attention. So perhaps some compelling story about Social Security going broke is a good way to get you to tune in. Also, if the answer to this question is no, if it's not going to be there, then just claim as soon as you can, and I'll let you enjoy the rest of your afternoon. If the answer is no, by the way, this is probably the shortest presentation you've ever attended. Let me show you some numbers. You can tell me what you think, okay? So assuming no changes are made to the system, benefits are fully payable for roughly the next 11 years. And then assuming no changes are made to the system, benefits would be reduced. They'd go down by roughly 20 percentage points. I'm not standing up here saying that's a good thing. Nobody wants to take a 20% pay cut from their Social Security benefit. But what I am saying is that when it comes to Social Security, there are built-in phase-out periods. This is the first phase-out in the year 2034. Benefits go down by 20 percentage points. The second phase-out is the year 2096. Benefits would go down by 6 more percentage points. I'll be about 120 at that point. Not sure about you. Social Security is not like this giant on-off switch. It's not like it's here one day and then just disappears the next. It would very slowly phase out over the next several decades if no changes were made to the system. Here are some proposed changes, some ways to keep the system solvent. So that first bullet point talks about the maximum earnings subject to Social Security tax. So this year, 2023, if I make $160,200 or more, I'm done paying into Social Security. There's typically 2 groups of people that attend these presentations, by the way. If you're fortunate enough to make 160 or more, you probably like that role. Sounds pretty good, right? And then for the rest of us, it's like, wait, so the wealthy people get a tax break once they've made enough money, but I have to pay all of my income into Social Security, and that doesn't really seem fair. And so one proposed change is to raise that maximum that's subject to Social Security tax. So if it's currently 160,000, maybe make it 250,000 or 500,000 or $1 million, or maybe just remove the cap altogether. And the running joke in my office is NBA, NFL, Major League Baseball, tax those guys on all of their earnings. You'd keep the system solvent for ever. Maybe throw in movie stars while we're at it. So that's one proposed change. That first bullet point talks about the maximum earnings subject to Social Security. On the second bullet point, I think for sure we're going to see some changes there, where it talks about the normal retirement age, full retirement age. It's the same thing. If you've ever looked at your statement or gone to the Social Security website, you might have seen that three-letter acronym FRA, full retirement age. One of the big deals about your full retirement age is that's when you'll get your full benefit. So if you claim at your full retirement age, you will get all of your check, 100%. You can claim before your full retirement age. I will demonstrate what that looks like. You can actually claim after your full retirement age. I will demonstrate that as well. But again, if you claim at your full retirement age, you will get your full benefit. And if anybody here was born between the years 1943 and 1954, then your full retirement age is 66. If anybody here was born 1960 or later, your full retirement age is 67. Does anybody want to ask a question? Yeah, so unfortunately, you guys can never retire. Okay, next slide. I kid. So here's the way this works. So if I was born 43 to 54, full retirement age is 66. If I was born 1960 or later, it's 67. And then for those of us born in between, we have a little bit of an add-on. So if I was born in 1955, it's 66 and 2 months. Or if I was born in 56, it's 66 and 4 months. So for every year later that I was born, they pushed back full retirement age by 2 months. To try to put these numbers briefly in context, this whole idea of Social Security only first came about in 1935. President Roosevelt was in office. At the time, full retirement age was 65. And sometimes the feedback I get from clients is I liked that more because, you typically sign up for Medicare at 65, full retirement age is 65. So those two numbers seem to sync up. But keep in mind that when Social Security was first incepted in 1935, life expectancy was 62. Oops. That's a little bit of a trick, people. Most folks never claimed any Social Security. Okay. And if we use that same math, we could argue that today's numbers should be somewhere in the 70s, maybe even in the 80s. The question I might ask is, when did this change? If full retirement age used to be 65 and now it's not, any guesses as to when it got pushed back? Stunned you into silence. It was 1983. Ronald Reagan was in office. He made several changes to Social Security. One of those was to push back full retirement age Let me ask you this, was there mass rioting in the streets? You don't remember the great Social Security riots of 83? No? It's because there weren't any. So they pushed back full retirement age. It didn't really affect anybody much past the age of 30 or 40. There's not mass rioting in the streets. So on this previous screen where I say, oh, it's simple, just raise normal retirement age, I'm not saying it's going to be years. It's not going to be decades. If your current full retirement age is 67, by the time you get there, it'll be more like 67 and 2 months, 67 and 4 months. There's a precedence for this. Those first two bullet points, that's really all the fixing that we need for Social Security purposes. The third bullet point talks about perhaps they'll lower benefits for future retirees. The last bullet point talks about making adjustments to the cost of living adjustment or COLA.
Hi, everyone. We appear to be having a technical difficulty. Thank you for your patience as we resolve it.
Endpoints that Social Security uses to determine income. That's the first bend point, that $1,024 and the 90%. On the second bend point, now we're getting 32% of our dollars back. That's roughly $1,647. The last bend point, we're getting 15%. That's another $788. And if we add the three bend points together, we eventually get down to that number in blue bold. So just as a quick confusing example, somebody born in 1961 who has maxed out Social Security, that's the biggest check they're eligible for at their full retirement age, $3,357.60. It could be less than that. It won't be more. And the next question I might ask is, do the words overly complicated come to mind? Are you kidding me? So in fairness, hang on one sec. Social Security will do the math for us. If you've ever gone to the website or you look at your statement, they will show you your monthly benefits. This is a little bit of behind the scenes sneak peek as far as where they calculate those numbers. Yes, ma'am. It's the average indexed monthly earnings, AIME. And so what they do, for all of us, they're doing the same formula or the same calculation. They're looking at our highest 35 years of earnings, and then they average that number, and then they index it to inflation. Yeah, good question. Yes, sir.
I'm saying on her, so if that's 11,000 a month, it's like 37,000 a year. They say the average household income is 74,000. So I was just curious why you're using that high of a number.
Yes, and I'll repeat questions because I realize maybe other folks can't hear. So the first question was just a confirmation or a reclarification of what AIME stands for and what it represents. And then you're bringing up a good point. If you look at average household earnings, it's nowhere close to this example. This is simply a for instance. And so a lot of the feedback that I've sometimes gotten is, well, what's the maximum amount that I could get per month? So if you want to tell me this is like a pie in the sky scenario and hey, most people don't earn anywhere close to that, you're right. I agree with you. But it's just a for instance. And that's why I said at the beginning, like your numbers are probably very different. This is just an example. But you're right. You're right. Good question. Any other questions here? All right. So the earliest I can claim Social Security is 62. But if I claim at 62, I'm not going to get the full benefit. I'm not going to get the full check. The math on this gets more and more complicated. I'll do the best I can to make things sound somewhat intuitive, but it partially depends on your full retirement age. Again, full retirement age, if you're born 1943 to 1954, it's age 66. If it's 1960 or later, it's 67. If my full retirement age is 66, but I choose to claim at 62, I'm going to get 75% of the benefit. Or if my full retirement age is 67, and I choose to claim at 62, I will get 70% of the benefit. And if I have one of those funky full retirement ages, like 66 and some odd months, then we'd have to do a little bit of additional math. Long story short, the earlier you claim, the smaller the percentage of the check that you're going to get. Now, depending on your full retirement age, that's when you'll get your full benefit. If full retirement age is 66 and that's when you claim, then you'll get your full check. Or if it's 67 and that's when you claim, that's when you'll get your full check. Again, long story short, the longer you wait, the bigger the monthly benefit. It does not make sense for everybody all of the time to wait. I think for some people, some of the time claiming early is the right decision. As an example, my dad passed away when he was 67. If he had been waiting to claim Social Security, he wouldn't have taken any money from the benefits that he paid in, and zero is not a good claiming strategy. So I think for some people, some of the time claiming early is the right decision. And I think for some people, some of the time, this next screen might be interesting. Because I don't actually have to start at my full retirement age. And why on earth would I keep waiting? I've waited long enough. I'd like my money back. Thank you very much. So here's the way this works. If I delay my claim, there are delayed credits, and I'm earning an extra 8% per year every year later I choose to claim. Again, it depends on your full retirement age. If full retirement age is 66 and you choose to claim at 67, you're now getting 108%. Or at 68, it'd be 116. At 69, it's 124. The system maxes out at age 70. And in that example, I'd be at 132% of my benefit. It's a guarantee of 8% per year, plus whatever the cost of living adjustment might be in any given year. Probably already giving you too many numbers and facts, but as a reminder, the cost of living adjustment for Social Security this year is 8.7%, plus the 8% that I'm already earning if I choose to wait. I'm earning almost 17% just this year if I choose to delay my Social Security. Anybody here earning 17% in a savings or checking account? CDs, money markets, government bonds? Stop me if I get warm. So for some of our clients, some of the time, the extra 8% per year is an interesting way to coordinate retirement planning. And I'm not saying that somebody has to work until 68, 69, 70. I'm saying maybe they don't claim until 68, 69, 70. There might be a huge difference the age at which somebody retires versus the age at which they claim Social Security. More about that in just a couple minutes. A couple different websites, links that you can access to look at your Social Security benefit, your earnings record. These are current and up to date. I will tell you that Social Security made changes to their website last year. It was December 6th. The website's a little more user-friendly, a little more intuitive. All of the content in this presentation can be found on the website, but it's a lot of information. It's really dense. You could probably start reading right now and die before you're finished. Or I have like half an hour left in the presentation. It's up to you. And I'm going to transition here. I'm going to talk about spousal benefits because just by virtue of the fact of being married, one spouse is automatically eligible for half of the other spouse's check. So quick example on the screen, John and Jane are a married couple. His monthly benefit is $2,000. Her monthly benefit is $800. If she claims on her record, she gets $800 per month. If she claims on his record, she gets $1,000 per month. Which check do you think she might prefer? Stupid question. Of course, she'd want the bigger of the two benefits, but there's not much about Social Security that's proactive. It's not like she claims on her record and then gets a friendly phone call from the local Social Security rep talking about spousal benefits. And I know I'm just a nerdy guy who gets way too excited about Social Security, but this is really found money for a lot of the people that I talk to. Again, if she claims on her record, she's leaving money on the table every month. And I'm going to switch back and forth between this screen and the next one just to go over some of the rules. So have to be at least age 62 if I want to file for spousal benefits. Hopefully that 62 figure sounds familiar. Have to be 62 if I want to claim on my record. Have to be 62 if I want to claim on a spouse's record. But the math is the same. Okay, so maybe Jane's going to claim on John when she's 62. She's only going to get a certain percentage of the half that she's eligible for. Again, it depends on her full retirement age. If her full retirement age is 66 and she files for spousal benefits at 62, she'll get 75% of the half that she's entitled to. It's still better than her claiming on her record, but if we show up early for spousal benefits, we still have that decreased income or that penalty. Have to be married for at least 1 year if we want to coordinate spousal benefits. And then one spouse must file for the other to be eligible. So maybe Jane wants to claim on John, but maybe he hasn't claimed yet. He's still working. He's too young, whatever the reason might be. She could claim on her record. And then when he files, she could actually switch. So that works. As long as we're switching to a bigger benefit, that would work. Just to be clear, I certainly don't want to seem sexist. Obviously, there's women who out-earn their husbands, so we could change the names. We could have Jane as the higher-earning spouse. For that matter, Social Security now recognizes same-sex marriage, the same as any other relationship. So the example could read John and John or Jane and Jane. We're just really after the concept here, okay? And I'm going to transition. We'll talk about divorce. There are situations where Social Security treats divorce kind of the same way as they do a married couple, but there are a few rules that we have to pay attention to. So in the case of divorce, if I want to claim on my ex, the marriage must have lasted 10 years. The person claiming on their ex has to be unmarried, and the ex has to be at least age 62. But as long as those three rules are in play, then there are men claiming on their ex-wives. There are women claiming on their ex-husbands. If you'll cast your eyes to the lower right-hand corner of the screen, more than one ex can claim on the same worker's record.
Ooh,
Just let that sink in. I'm not sure how many people remember Johnny Carson. I know he's deceased at this point. Just humor me here for a second. When he was alive, he actually had 4 ex-wives, and 3 of those marriages lasted 10 years or more. So check this out. Johnny's ex could get half. Johnny's ex could get half. Johnny's ex could get half. Johnny gets all of his. Johnny's current wife could get half. So it's not like they take the benefit and chop it up and split it up all these different ways. Johnny would actually never know that those women claimed on his record. It doesn't affect him, doesn't affect his now current spouse either. This is sometimes the point at which people say, no wonder the system is going broke. But I really don't think people know the rules. And along the lines of what we're talking about here today, let's talk about surviving spouses. Not a fun subject, but it's relevant. And it comes up more often than we might like to think about or talk about. So let's go over the rules here. Another example on the screen, John and Jane, married couple. His monthly benefit, $1,200. Her monthly benefit, $2,000. So just for purposes of Social Security, it's $3,200 combined. Sorry to say that Jane passes away. The good news here is that John, as the surviving spouse, is going to step up to the bigger of the 2 benefits. But unfortunately, he stops getting his own check. And if you can see at the bottom of the screen, the concept basically reads, when one spouse dies, the surviving spouse gets the greater of the 2 benefits, but not both. We're never going to get more than one Social Security benefit. You'll get the biggest check that you're eligible for, right? So he is going to step up to her benefit because hers was bigger than his, but now he foregoes his own check. And so what was $3,200 in benefits is now $2,000. That's a pretty significant loss of household income. Go ahead, Gail.
well, question, one could collect the Social Security if you're not claiming your own yet and let that build up to like to 70 and then would get the greater of the benefit.
So Gail is correct. So not to sound morbid, but there's a little bit more flexibility when it comes to surviving spouses. And so if unfortunately my spouse predeceased me, it depends on had she claimed or not and how old she was and if I filed or not. But in theory, I could file on her record and then switch back to mine. I haven't claimed on my record, so I'm still earning the 8% per year. Or maybe I claim on my record and then switch to hers. It just depends on how the numbers or the math works out. But there's definitely more flexibility here than there was with spousal benefits or even ex-spousal benefits. And then just to be clear on the rules, so eligibility wise, the marriage must have lasted 9 months. And by the way, if you're confused on timeframes, you're probably in really good company. So at the risk of repeating myself, in the case of a married couple, marriage must have lasted a year. In the case of a divorced couple, the marriage must have lasted 10 years. In the case of a surviving spouse, the marriage must have lasted 9 months. Couldn't they take all the time frames, add them up, divide by 3, just use the same time frame for everybody? I swear they make this stuff as complicated as possible. Now, if you'll notice, I'm still on the left side of the screen. Couple exceptions to the rule. Benefits can be taken as early as age 60. Normally, the earliest we can claim is 62. In the case of claiming on a surviving spouse, I could claim as early as age 60, but not if I happen to have gotten remarried prior to the age of 60. So here's an example. Let's say I'm working with a married couple. Let's say the husband passes away. The widow comes to me and says, good news, I'm getting remarried. And maybe she's 58, 59. I'm going to say, congratulations. No, you're not. And this is not romantic. Nobody thinks about Social Security when they exchange their marriage vows. But from a planning perspective, it's a big deal. If my client were to remarry prior to the age of 60, she is not eligible to claim on her deceased husband. Or she waits until 60 and then gets remarried. She is now eligible to get all of whatever that person's benefit might have been. So not a fun subject, but it's important to talk about, especially in the context of planning and retirement. And there's obviously important factors to keep in mind. In some ways, my job is more art than science because I don't have all the information that I'd want to help somebody make an informed, educated decision. If you could kindly tell me the exact date and time of your death, then I would tell you exactly when to claim Social Security. So there are some important factors to keep in mind. Health status. If somebody is not healthy, it probably does make sense to have them claim sooner. It's not fun to talk about, but you're not getting a check when you're not here. What about life expectancy? How long did your parents or your grandparents live? If there's a chance that you might make it to your 80s or 90s, you probably don't want to claim early. You're probably leaving some money on the table. And some people simply need the income. Some people don't have the luxury of any of this information. We saw this a lot with COVID. People lost their job, they got downsized and didn't really have a choice. And I get that. I was talking with a gentleman a couple of years ago. He said, Brad, I don't even want my ends to meet. I just want them to wave at each other. He didn't have a choice. He claimed at 62. I get it. The flip side is I've talked to people and they kind of shrug their shoulders and they say, well, I didn't need the money. I just claimed because I could. Somebody at the church talked me into it. Somebody at work convinced me. This is one of the biggest financial decisions that all of us are ever going to make. I would hope there's more planning in place than because I could. And just as a quick aside, I mentioned there's a whole other class that I teach about Medicare, and I'm not going to spend too much time on this slide, but there's definitely some confusion here. So at some point, you're going to claim Social Security. At some point, you're going to claim Medicare. Typically, people sign up for Medicare at the age of 65. And I'd love to stand up here and tell you that Medicare is free and that it pays for everything. But that is not the case. So as an example, Medicare Part B, this is like trips to the primary care physician, outpatient services, annual checkups, mammograms, preventative maintenance. Medicare Part B, most people this year are paying about $165 per month. That Medicare Part B premium comes out of the Social Security benefit. It's automatically withdrawn. When it comes to Medicare, if I make too much money, then I end up paying more for those premiums. And so sometimes the feedback that I'll get is, well, what the heck? They're shrinking my Social Security check. That's perhaps the net result. What's really happening is you made too much money. They increased your Medicare premium, which means that your Social Security check is a little bit smaller. Just something to keep in mind. And again, there's a whole other class that I teach about Medicare if anybody is interested. Now, here's a chart that condenses some of these numbers into one nice, neat package. I'll walk you through the information. On this screen, we're assuming that full retirement age is 66. Earliest we can typically claim is 62. If my full retirement age is 62 and I claim at if my full retirement age is 66 and I claim at 62, I'm going to get 75% of the benefit. In this example, it's going to be roughly $2,500 per month. Long story short, the longer I wait to claim, the bigger the monthly check. Again, assuming full retirement age is 66, that's where I get my full benefit. There's that 3,357 figure. The number all the way on the right is factoring in the cost of living adjustment. On this screen, I'm using 2%. And then for full retirement age until 70, I earn the extra 8% per year. The system maxes out at age 70. There's no added benefit if I wait until 71, 72, 73, et cetera. So it maxes out at age 70. In this example, the benefit at 70 is $4,431. Factor in that cost of living adjustment, it's a little bit closer to $5,200. It does not make sense for everybody all of the time to wait. I think for some people, some of the time claiming early is the right decision. And I think for some people, some of the time, the income figures later on in life might be a little bit interesting. And as this gentleman correctly pointed out, this is kind of a pie in the sky example. Most people don't max out their Social Security for 35 years. So what about the rest of us? What if my income is less? What if my Social Security benefit is smaller? Here's a quick rule of thumb, and it plays out on this screen, and it's going to play out with your benefit. It plays out with all of our benefits. Rule of thumb, the check at 62 is 50% the check at age 70. And that's regardless of how long you paid in, whatever your income is. The check at 62 is going to be almost exactly half of the benefit at age 70. So, and time permitting, the last thing I'll demonstrate is the Social Security analysis, where I take a real life couple, demonstrate a couple different ways they might claim their benefits. We can talk about crossover or break-even points, right? If I claim at 62, sure, I'm getting a smaller percentage, but I'm getting money up front. If I wait until 70, well, yeah, I'm getting a bigger benefit, but I've given up 8 years of income. How long does it take to catch up or break even to where I would have been? But again, keeping in mind that the benefit at 70 is twice the benefit at 62, in some circumstances, you're never going to catch up. And the longer we live, the bigger the difference between the claiming strategies. So you can look at the left side of the screen and figure out whatever number you think is relevant or realistic for life expectancy. I will tell you that based on a recent census report in this country, average married couple, age 50 or older, there's a 47% chance that one of you will make it to age 90. Sorry, maybe that's bad news for some people in the room. Maybe you don't want to live that long. Might be in the cards for some of us. Just as an aside, one of the unfortunate realities in my world is that people used to buy life insurance for fear of dying too young. I just met with a client earlier this morning. She said the exact same thing. I'm worried about outliving my money. I'm worried about outliving my assets. It's a concern. It's something to keep in mind. So again, look at the left side of the screen, determine whatever number you think is realistic. I'm going to look at that line item for age 90. If I make it till 90 and I claimed at age 62, well, then the monthly benefit is $4,213. Or if I make it till age 90, having claimed at 70, the monthly benefit's about $7,500. If I make it to 90, I know which check I'd rather have. I know which check my wife would rather have. And for most people, most of the time, the difference from one column to the next will be the difference between dignity and poverty. Ties back to the point I made earlier about single elderly folks living at or below the poverty level, okay? Couple key points to keep in mind. If you apply early, your benefit starts lower and it stays lower. This is basically an irrevocable decision. However, you do a one-time do-over, meaning you've applied for Social Security, you're getting those monthly checks. Up to 12 months after the first check arrived, you could pay all of the money back, be a big check, but you could pay all the money back, and it's like you never showed up. You could do that one time up to 1 year after you get your first check. But 12 months and a day after you started claiming, it's a done deal. Second bullet point talks about the cost of living adjustments, how they magnify the impact of the claiming decision. We just saw that on the previous screen with the differences in the checks at age 90. And then that last bullet point is interesting. So never a fun subject, but if I'm talking to a married couple and one or the other is concerned about providing protection for their spouse when they're gone, then I actually think for some people, some of the time, this conversation about Social Security ties into conversations about life insurance and long-term care. I'm not saying that waiting to claim Social Security eliminates the need for life insurance or long-term care, but I think it certainly reduces those needs. And just to be clear, I am insurance licensed. I probably talk myself out of more business than I talk myself into. But when I'm talking to clients about their retirement plan, I think this is a really key point to keep in mind. That bigger Social Security benefit means that I probably can reduce the need for life insurance and long-term care. How do I maximize my benefits? Just a couple thoughts, couple strategies here. This first strategy talks about your earnings record. Would it surprise you if I said sometimes the government makes mistakes? Shocking. Should have asked if you were sitting down first, right? Sometimes the government makes mistakes. It's the same formula for all of us. You can see the link to the web address on the screen. I think it makes a lot of sense to check your numbers on an annual basis. This will literally take you about 2 or 3 minutes per year. There's no point in paying into Social Security and not getting credit for those dollars. And this is one of those, like whether you're 10 or whether you're 100 kind of deals, because every time we earn income in this country, we have to pay into Social Security, but check the numbers and make sure they're accurate. And I mentioned this early on, there's not much about Social Security that's proactive. If the numbers are wrong, I have to prove that they made a mistake. And so I'm typically showing them tax statements, W-2 earnings. If I have to go back 2 or 3 years, I have those documents, no big deal. If I have to go back 2 or 3 decades, it's not going to happen. And again, there's no point in paying into the system, not getting credit for those dollars. Are there any missing years? It's the same 35-year formula for all of us. If I've only paid in for 20 or 25 or 30 years, I'll have some zeros on my record, but I could certainly improve my record by working longer. We could argue that a part-time job today nets as much as a full-time job did 30 or 40 years ago. And believe it or not, there are people who are still working and they've already claimed Social Security and they're still paying into the system and they're actually improving or increasing their record and seeing a slight change in that monthly check. But that comment sometimes ties into this next strategy where we talk about the earnings test. So if somebody applies for Social Security early, by early, I simply mean prior to your full retirement age. Again, your full retirement age is specific to you depending on the year that you were born. If you're going to apply for Social Security before your full retirement age and you're still working, you can only make $21,240 per year. If you go over that limit, then for every $2 you go over, they're going to withhold $1 worth of benefits. It's a 2-to-1 ratio. Here's a quick example. Let's say there's a 62-year-old, they're working, let's say they're making $50,000 per year. They don't know the rules. They think they're being clever. They're going to claim Social Security. Hey, I don't even need that money. I'm going to invest it. I could do a better job with my money than the government can, right? All right, well, here's, right, so they're making 50. Let's just say the limit's 20,000 just to keep the math simple. So in that example, they're 30,000 over the limit. And then there's this 2-to-1 ratio for every dollar that I earn, right? So if they're 30,000 over, it means that $15,000 worth of their benefit would be withheld on an annual basis. 15,000 per year is going to be withheld from Social Security. By the way, take 15,000, divide by 12 for the 12 months of the year, it works out to $1,250. If in that example, the monthly benefit was $1,250 or less, guess how much they're taking home from Social Security every month? Zero, nothing. This happens every year. People don't know the rules. They claim Social Security. They're not yet at their full retirement age. They wait for that first check with bated breath and it never shows up. Why not? It's because of the earnings test. Now, once you reach your full retirement age, you can work, you can make as much money as you want and claim Social Security, and there's no give back. But before your full retirement age, you're going to hit that 21,240 mark pretty quick. Yes, sir.
That 21,400 income that gross.
Good question. So the question is, hey, that 21,240 or whatever the number might be, because it does tend to adjust a little bit from one year to the next. That is based on gross income. It's actually based on adjusted gross income to be precise, or AGI. So just to be clear, if somebody has pension income, you have investment earning income, you have income from a passive entity like a rental property, that's not going to count for purposes of that 21,240. It's really just earned income. Good question. All right, so coordination of spousal benefits. I'm going to switch, I'm going to click over these next couple slides very quickly. It's very difficult to coordinate spousal benefits anymore. There used to be a strategy called file and suspend. Congress, in their infinite wisdom in the year 2015, said, no, can't do that anymore. There's another strategy called claim now, claim more later. I'm happy to talk about this after the fact, but just in the interest of staying on schedule, I'm going to transition to information that's actually more relevant for folks in the room. Plus, I want to make sure we leave enough time for taxes because I know that's everybody's favorite subject. And it is possible, maybe even likely, that some of your Social Security income will be subject to federal taxation. New Mexico used to be one of 13 states that taxed Social Security at the state level. Most people that I talk to will not any longer have to pay state level tax on the Social Security benefit. However, as an individual, if you make 100,000 or more, or as a married couple, if it's 150,000 or more, then you will still have to pay state level tax on your Social Security benefit. So roughly 85% of the New Mexico population will not have to pay state level tax. The numbers that I'm demonstrating on this screen, these are for federal taxes, okay? And it's a sliding scale, as are most taxes. So just as an example, if you file as a married couple and your joint income is 44,000 or more, then 85% of the Social Security benefit is subject to tax. Just to be clear, it's not an 85% tax. 85% of the Social Security benefit is taxable, and then it just depends on whatever your federal tax rate or bracket might be. And we can spend time later on figuring out whether or not this is fair. Pretty sure I already know the answer. Just as oh, by the way, when we were talking about solvency or ways to fix Social Security, I mentioned that Ronald Reagan made some changes in 1983. 1983 was the first year that we saw taxation on Social Security benefits. And all of those income numbers, every number that you see after a dollar sign, those numbers were first created in 1983. So thank goodness we haven't had any inflation in this country for the last 40 years. This should be criminal. And by the way, this is one of the sneaky ways that they add solvency to Social Security. So when people sit in a presentation and they think, I'm just going to claim it as soon as I can because the system is going broke. No, it's not. This is one of the ways that they very sneakily add solvency to Social Security without telling anybody. There's no reporting. I'm guessing that most, if not all of you in the room didn't know this. Typically, when we talk about taxation, that income goes to the IRS. All of these taxes go back to Social Security. Just stop and think about that. That's how I know that Social Security is not running out of money. Anyway, a couple different ways to perhaps minimize the taxes on our Social Security benefit. Here's a slide with a bunch of tiny words on it. I'm going to pick on that second bullet point. I think that's one of the most interesting concepts on this screen. So the second bullet point talks about IRAs and RMDs. IRA is individual retirement account. RMD is required minimum distribution. So whether you have an IRA, a 401k, a thrift savings plan, a 457, a 403b, sometimes even annuities, with the exception of Roth accounts, if you have an investment account that's growing tax-free from one year to the next, you're going to be forced to start taking money out of that account at a certain age. The age is currently 73. It's going to get pushed back to 75. The numbers have changed recently over the past couple of years, so there's some confusion regarding required distributions. But point being, if you have an IRA or a 401k type account, you're forced to start taking money out at a certain age so that you're forced to pay the taxes. That being said, you can typically access those accounts as early as 59 and a half without penalty. I mentioned this earlier. The age at which you claim Social Security might be very different from the age at which you retire. Now, maybe some people choose to keep working. Maybe some people retire and do a part-time gig. Maybe some people retire and they have a side hustle that generates some income. Or maybe some people retire and they start drawing down on IRA and 401k type accounts to bridge the income gap, right? I'm not working, don't have any income there, haven't claimed Social Security, no income there. What am I supposed to do in the meantime? Well, if you really don't have any income and the money taken out of a 401k or an IRA is taxed the same as income, then it's smart to draw down those accounts when you're not working before you claim Social Security. I know this is somewhat counterintuitive. I feel like a lot of the people that I talked to heard the opposite. Claim Social Security before it goes broke, and then don't ever touch the IRA or the 401k. That's your emergency account. That's the rainy day fund. I'm telling folks the exact opposite. Based on extensive research on my part, that actually adds safety and security to the overall retirement plan. And just as a quick aside, I take a pay cut when I talk about this. So I don't charge a speaking fee. I don't get paid to talk about Social Security or Medicare benefits. I get paid to manage investment accounts. If I'm managing your investment account and I say, hey, here's a good way to save taxes, you should start drawing down on your IRA before you claim Social Security, I take a pay cut. But I can't guarantee you 8% per year plus a cost of living adjustment the same way that Social Security can. And typically speaking, when I'm talking to folks about Social Security, I think retirement is a lot more than just Social Security. What are the other moving parts and puzzle pieces? How do we make intelligent decisions? I don't want any of our clients to make decisions in a vacuum. So most of our clients do have a customized plan in place to make sure that you can successfully retire and stay retired. And in the interest of time, I'm going to fast forward here a little bit. This is basically a glorified Excel spreadsheet. I think of it more as a tool to figure out when should I claim. This is a married couple. I can customize these any number of different ways. We talked about divorce. We talked about deceased spouses. We didn't even talk about Social Security disability. There are even situations where dependents might be able to get a percentage of their parents or maybe even their grandparents' Social Security. So this is just a quick, for instance, but just know that all of this is highly customizable. In the example, Joe and Denise Sample. So married couple I met with earlier this year, I just changed their names to protect their confidentiality. He was 64, she was 62. It's color coded to make it a little easier to decipher. So everything in green is his info, everything in yellow is hers. If he claims Social Security at full retirement age, he's getting roughly $2,400 a month. If she claims at full retirement age, she's getting more like $1,600 a month. But they could claim immediately, right? Have to be at least 62. They're there or better. Maybe they really should claim right now. Maybe that makes the most sense. I don't know. That's why we might run the numbers. But keep in mind that if he claims at 64, he's not getting his full check. He's getting $2,080. If she claims at 62, she's not getting her full check. She's getting $1,200. On this report, I used a cost of living adjustment of 2%. I'm using 85 and 90 for the life expectancy numbers. I'm going to scroll down here a little bit. We can see what the income numbers look like. So she claims at 62, it's $1,200 per month, it's $14,400 per year. He claims at 64, it's about $2,100 a month, it's almost $25,000 per year. Combined monthly is about $3,300, combined annual is almost $40,000. I know that for some people, some of the time that's going to be tempting. Let's see, I get $40,000 per year not to go back to work. I think for a lot of people, that's an easy decision. Now, the income is going to increase a little bit from one year to the next. That is based on the cost of living adjustment. I'm going to fast forward here. I mentioned that life expectancy for the husband for Joe is 85. Hopefully you can see that as evidenced by the zeros, because in theory, you're not supposed to claim Social Security when you're dead. Not that some people don't try. When they were both alive and both claiming, it was about $60,000 per year. Keep in mind that the surviving spouse gets the greater of the two benefits, not both. And so in that next year, what was $60,000 is now $38,589. Ouch. And if there's no other savings, no other earnings, the house isn't paid off, there's medical issues, this dynamic of losing one check could ruin retirement for the surviving spouse. But that being said, if you look at all the money they took out of Social Security, add it up, put it into a big pile, it's just north of $1.36 million. So this strategy is not wrong. It's not bad. I promise they took out more than they paid in. But there's another example that I might prefer for Joe and Denise. I actually ran 6 different scenarios. I will not bore you with all of them. Same numbers up at the top with their ages, the monthly benefit. In this example, I'm showing him claiming at age 70. His benefit at 70 is $3,568. I'm showing her claiming at her full retirement age. At full retirement age, she'd actually get closer to $1,900 per month. Same 2% cost of living adjustment, same life expectancy assumption. One of the things I liked in that first example was they got money immediately. It was almost $40,000 in that first year. Now the first year benefit is nothing. Zero. I'm sure that makes me really popular, right? But that's the idea of planning. We'd have to figure out some way to fill in those missing years. Again, maybe they choose to keep working, maybe it's part-time work, or maybe they start drawing down on IRAs or 401ks. When the income finally kicks in, combined monthly is about $5,500. Combined annual is about $66,000. I'm going to fast forward here. Again, he passes away at the age of 85. Again, as evidenced by those zeros. But in the previous example, when he died, she was left with roughly $38,500. Now it's $58,772. So I am more than $20,000 per year ahead here versus where I was in that first example. And that's for having those years of zero on the front end. And in that first example, the total cumulative benefit was about 1.36 million. Now it's almost 1.7 million. So I am more than $300,000 ahead here of where I would have been in that first example for having those years of zero at the front end. And by the way, if you don't think that's a lot of money, I am very adoptable. No takers? All right, so you have a couple pieces of paper, and for folks who are online, I'll give this information to Gail. Let me just show you what you're looking at. The first piece of paper is just a brief overview, has some of the highlights from today's presentation, also has my contact information. I don't charge an hourly fee. You can call, you can email. I'm always happy to talk about Social Security and Medicare benefits. Second piece of paper is an evaluation form. I love your feedback, good, bad, or indifferent. So towards the top, you can tell me what you liked or what you didn't like, or even make suggestions for next time. And then towards the bottom, if you want, you can get back in touch with me. So letter A is your personal Social Security analysis. I don't charge a fee to run those numbers. Again, it's this report just in a format that's more specific to your scenario, your situation. So if you want, circle letter A, put down your contact info. All that I need is your date of birth and the monthly benefit at full retirement age. Letter B is a huge part of the reason that I'm here. Maybe you know other people that should have been here, wanted to be here. Maybe you know other groups that are looking for speakers, other speaking opportunities. I'm always looking for ways to spread the word. I'm not trying to toot my own horn, but hopefully you got some valuable information. And I'm guessing that you learned at least a thing or two about Social Security that you didn't know. Go ahead and go to the Social Security website. Go ahead and call Social Security. Good luck. So if you know other groups that are looking for speakers, there's no sales pitch here. Again, I don't charge an hourly fee. I'm really looking for ways to spread the word. That's a huge help to me. If you know other people that should be here, other groups that are looking for speakers. Letter C, maybe there's something else that I mentioned about retirement planning, investments, insurance. I work on a team with 7 other advisors. We really do look at all the moving parts and puzzle pieces of retirement. If you put down your contact information, I'm happy to get back in touch. If you don't, I won't bug you. Last thing, and then I'll shut up. If you did get anything of value, please thank Gail. Please thank Melissa. I would not be here if not for them. Probably goes without being said, an event like this does not just happen accidentally. So Gail and I were talking about this months ago. Gail has been working hard. This is the 6th annual event. So please thank her if you got anything of value. I'll stick around afterwards as long as you want to answer questions. But folks online, thank you. And then folks in the room, thank you. I appreciate you being a great audience.